Welcome to episode 78 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we've got a lot to cover, so let's dive right in. Our first topic is a major development in the Canadian housing market. Canada Mortgage and Housing Corporation says the annual pace of housing starts in August slowed by 22% compared with July. This is quite a significant drop and has implications for both buyers and sellers in the market. The National Housing Agency reports that the seasonally adjusted annual rate of housing starts came in at 217,405 units in August, down from 279,804 units a month earlier. This drop came as the annual pace of urban starts fell 24% to 199,478 units, compared with 261,043 in July. It is important to note that the annual rate of starts for multi-unit urban projects such as apartments, condominiums, and townhouses saw a more drastic decline of 29%, coming in at 154,290 units. Conversely, the rate of single-detached urban starts actually rose by 3% to 45,188 units. Meanwhile, the annual pace of rural starts was estimated at 17,927 units. Although this number may seem small compared to urban starts, it is still a crucial part of the overall housing market. Canada Mortgage and Housing Corporation also noted that the 6-month moving average of the seasonally adjusted annual rate of housing starts was 248,480 units in August, down 2.9% from 255,794 in July. This moving average is often used to smooth out the volatility in month-to-month data and give a clearer picture of the long-term trends. So, what does all this mean for you? For prospective homebuyers, this slowdown in housing starts could mean less inventory coming onto the market, potentially driving up prices. On the flip side, for current homeowners looking to sell, it might be an opportune moment, as reduced inventory could make your property more valuable. We'll continue to monitor these trends and bring you the latest updates. Next up, we'll delve into the reactions as the housing market remains stagnant in August. Canada's housing market continues to tread water, showing only modest improvements in August, according to a report by the Canadian Real Estate Association. The Canadian Real Estate Association released its latest national home sales report, which showed a 1.3% month-over-month uptick in resales in August. Actual, not seasonally adjusted, monthly activity came in 2.1% below August 2023. Despite small signs of growth, industry experts said the market remained mostly stagnant, with buyers hesitant to act amid rising inventories and stabilizing prices. Despite some fledgling signs of life to kick off the long-awaited monetary policy easing cycle, Canadian housing market activity still looks to be stuck in the same holding pattern it's been in all year, said Canadian Real Estate Association senior economist Sean Cathcart in the report. That said, with ever more friendly interest rates now all but guaranteed later this year and into 2025, it makes sense that prospective buyers might continue to hold off for improved affordability, especially since prices are still well behaved in most of the country. As inventories rise, buyers are feeling less urgency to act quickly, a shift from the frantic pace of previous years. According to RBC Assistant Chief Economist Robert Hogue, the number of homes available on the market is now equivalent to 4.1 months of sales, more than double the cyclical lows seen in 2021. This gives buyers more time to consider their options and negotiate, which has eased the pressure many felt to rush into deals at inflated prices. There are more options for them to choose from, said Hogue in a statement. More balanced supply and demand conditions also give them a stronger hand in negotiating prices, contributing to stabilizing property values. The National Composite Multiple Listing Service Home Price Index remained unchanged between July and August, holding steady at $717,000, down 3.9% from last year. Stable prices, or the possibility of declines in some markets, further lessens any urgency for some potential buyers to jump in, added Hogue. The supply side will continue to be in focus in the meantime. The rise in inventories to date has generally been a positive development, easing what were previously severe shortages in several markets. Hogue noted that the housing market may remain subdued for the near future, but he expects activity to gradually pick up as the Bank of Canada continues cutting interest rates in the coming months. However, a significant surge in activity may not happen until the spring. While interest rates have come down slightly, buyers in high-priced markets like Toronto and Vancouver are still facing significant challenges in qualifying for larger mortgages. Clay Jarvis, a spokesperson for NerdWallet Canada, pointed out that home sales in cities with average prices over $600,000 have dropped year over year, reflecting buyers' difficulties in securing the financing needed to buy homes in these regions. That tells me Canadians in pricier markets are having trouble qualifying for larger mortgages, with rates and home prices at their current levels, he said. Cities like Toronto, Vancouver, or Calgary will all likely see further sales decreases, which will put a damper on national real estate activity this fall. Jarvis added that while fixed mortgage rates are slightly lower than they've been in recent months, many buyers are waiting for further rate cuts from the Bank of Canada before making a move. Jarvis suggested that buyers might want to get pre-approved for a mortgage now, as variable mortgage rates could fall with future Bank of Canada rate cuts, though it may take several more reductions for them to become cheaper than today's fixed rates. 3- and 5-year fixed rates are cheaper than they've been in a while and could sink even closer to 4%, he said. Lenders are hungry for business after a dreadful first 8 months of the year, so buyers might want to take advantage of that desperation and get pre-approved before the market wakes up. Canadians are becoming more hopeful about their finances, including home buying plans and retirement savings, as the Bank of Canada continues to cut interest rates. A recent survey by Maru Public Opinion revealed that 13% of Canadians are considering buying a home within the next 2 months, up from 11% in the previous survey. The increase is most noticeable among younger Canadians, aged 18 to 34, and in regions like Manitoba, Saskatchewan, and British Columbia. This rise reflects a steady upward lift since reports surfaced in May that the Bank of Canada was likely to begin cutting interest rates in June, said Maru Executive Vice President John Wright. The cuts have eased borrowing costs, making home ownership seem more attainable. However, Wright also suggested that for some, the motivation to buy may be driven by a need to sell existing homes and downsize to reduce debt. There is growing pressure that there is a group who need to get out from under debt and expense, Wright said. The marketplace is not just a buyer's market. There is a great pent-up demand for selling. Either way, anything that moves the marketplace for buying homes is generally seen as a positive. The survey also showed an increasing focus on retirement planning, with 56% of respondents saying they plan to save for retirement, up from earlier surveys. This marks the highest level of retirement saving intentions since January 2021, suggesting that Canadians are shifting their attention toward long-term financial security as interest rates ease. A growing number of Canadians are also feeling more optimistic about the economic prospects in their communities. 45% believe their local economy will improve in the coming months, up from 38% in July. Though modest, this uptick reflects a gradual improvement in economic confidence as rate cuts begin to take effect. While optimism is on the rise, financial difficulties remain a reality for many. The survey found that 41% of respondents are struggling to make ends meet, up from 38% in the previous poll. Wright noted that this trend has been steadily increasing, particularly in urban areas where the cost of living is higher. Moreover, 54% of Canadians reported being concerned about their daily finances, with 11% indicating they might face bankruptcy, both slight increases from earlier surveys. Overall, the Maru Household Outlook Index improved for the third consecutive month, reaching 90 points, though it remains below 100, indicating continued caution. The index, which measures how Canadians feel about their personal finances and the broader economy, has been in negative territory since December 2021, with its lowest point in March 2023. Ottawa's recent changes to mortgage rules are designed to spur demand among potential home buyers, but experts warn that supply challenges are likely to persist in Canada's real estate sector. The federal government's changes, set to come into force in mid-December, include a higher price cap for insured mortgages to allow more people to qualify for a mortgage with less than a 20% down payment. The price cap for insured mortgages is set to move to $1.5 million from $1 million, marking the first boost since 2012. Additionally, the government will expand its 30-year mortgage amortization to include first-time homebuyers buying any type of home, as well as anybody buying a newly built home. These changes are expected to address significant pent-up demand in the market. Speaking at a luncheon panel in Toronto, Mortgage Professionals Canada President and Chief Executive Officer Lauren Vandenberg praised the changes as fantastic news designed to address the significant pent-up demand in the market. We're seeing nowhere near enough supply, and we're seeing people go from excitement about the possibility of that dream of home ownership to desperation, said Vandenberg. I don't think we can hide our heads in the sand when it comes to demand and only focus on supply. I think recognizing the situation we're in is step one. The luncheon, billed as a discussion on Canada's housing affordability crisis, also heard from Desjardins chief economist and strategist Jimmy Jean. He was more skeptical about the changes, calling the announcement a debt finance solution to affordability. Jean explained, "It gives the impression that things are affordable, but people just end up paying more interest over their lifetime." The federal government touted the measures it announced as the boldest mortgage reforms in decades, following a year of criticism over high housing costs. In a note published on Tuesday, CIBC Capital Markets Deputy Chief Economist Benjamin Tal said the government's actions would likely accelerate the recovery of the housing market, a process already underway as interest rates have begun to fall. To prevent that from becoming too much of a good thing, we need to match the additional demand with supply, said Tal. The core issue is the lack of supply available to respond to a rapidly increasing population. The additions to demand from these mortgage changes will make it even more imperative to deliver on policies aimed at inducing more home building. However, Jean pointed out the practical challenges in Canada's strategy to build new homes in the coming years. The Canada Mortgage and Housing Corporation forecasts that Canada will require an additional 3.5 million housing units by 2030, on top of the 2.3 million already projected to be built, to restore affordability to 2004 levels. Jean said achieving those targets would mean pulling much of Canada's labor and capital resources into one sector, leading to shortages elsewhere in the economy. We've been focusing on supply, but we need to be realistic, he said. We've seen this for the last 2-3 years and how slow things are moving. I think the solution has to be on the demand side and what's being done to really curb that demand in order to balance out the market. Vandenberg expressed hope that the federal government's moves would generate momentum on the housing file, describing a sense of agitation among homebuyers that her association hears from. She noted that the Bank of Canada's 3 consecutive cuts to its key lending rate, along with economists' predictions of more to follow in the coming months, have sparked cautious optimism among those waiting on the sidelines. It's something that our members have asked for because it's what they're hearing from their clients on the ground, she said of the mortgage rule amendments. They've asked us for this because it's a critical piece of the affordability puzzle, a critical piece of the accessibility puzzle when it comes to this housing crisis. Our final topic today is a bit of a reality check for anyone looking to buy a home in Ontario. A new study from real estate website Point2 Homes has found that it could take up to 40 years to save for a down payment on a home in some cities. That's right, 40 years. Point2 Homes surveyed people looking to buy a home and calculated the estimated down payment needed in cities across Canada. Despite the lengthy timelines to save and the high cost of living, many Ontario residents still want to buy a home. The survey found that 62% of renters want to buy a home by the end of the year. However, 7 in 10 renters have less than $30,000 in savings, and 66% expect to need less than $50,000 for a down payment. But here's the reality check. Many starter homes require more than $50,000 for a down payment, particularly for properties in the Greater Toronto Area. As home prices have increased, the standard down payment for average homes and starter homes has also gone up. Given that the benchmark home price is now close to $700,000, the 20% down payment needed is close to $140,000. Saving around $70,000 represents an incredible financial effort for most renters, no matter their age and income. In the most expensive areas, like Vaughan and Markham, it could take anywhere from 10 to 40 years to save enough for a down payment, even for a starter home. Potential buyers in these areas will need over $130,000 for a down payment. Vancouver, Toronto, Mississauga, and Surrey are not far behind, with a down payment of over $100,000 needed. However, there are lower-priced options. Saving for a down payment in cities like Ottawa and London will take much less time, with just over $60,000 needed. The study also looked at how long each generation would need to save. Generation X is looking at 4 to 5 years to save for a home in cities such as Ottawa and London, while the youngest renters would need around 15 years. The youngest renters in the Greater Toronto area would have to religiously set aside 20% of their income for 30 years, while millennials are looking at around 9 years. So, there you have it. The dream of home ownership is still alive, but requires a significant financial commitment and a lot of patience. Whether you are a first-time home buyer or someone looking to move up the property ladder, understanding these timelines and financial requirements is crucial. That wraps up episode 78 of the Ontario Mortgage and Real Estate Insights podcast. Thanks for tuning in. I'm your host, Steve Hamilton, and we'll catch you next time with more insights and updates on the Ontario real estate market. Take care.